The thing we say to a client that want to invest in OpenAI is just buy Microsoft stock. It's going to be fine.
Bringing liquidity is healthy. If you prepare for IPO, as I mentioned earlier, it's very healthy that the people that want to exist are replaced by later stage investors that want to stay.
Whatever happens in the last round in terms of valuation, we never talk about it because 2021 was not the real world.
Hey everybody, welcome to SecondaryLink Pre-IPO Stock Podcast. With me today, I have David Leroy, co-founder and CEO of NotSoLiquid, and Pierre Leroy, co-founder and COO of NotSoLiquid. So gentlemen, welcome. Perhaps we can just start with a kind of a quick intro. So maybe David, just like 30 seconds, right? Just hit us quick with a little bit of your background, and then Pierre, we'll have you do the same.
Yeah, thank you very much, Aaron, for inviting us to this. That's a great opportunity. That's very cool to be featured in SecondaryLink. So my name is David Laroque. I grew up in New Caledonia, a French island in the South Pacific, and moved to France, mainland France, over a bit more than 16 years ago. I've navigated in finance for a while. I've been a VC investor, private equity investor. I created an investment bank back in 2017 with other alumni from Rothschild, and we did that for 4 years. And in 2021, we did a bit of a spin-off, a new business with Pierre called NotSoLiquid. We decided to embrace the opportunity of secondary that was booming in 2020, 2021, but we wanted it to be more organized. And Pierre has been a friend for a while, and he had this great idea and had the chance to join him, and we co-founded NSL.
Very cool.
And, hi, Aaron. Thank you so much. For my part, I also grew up on an island. So it was in Madagascar. Then I get back to France, started my career in finance, investment banking in London, Brussels, and Paris. And then I ran a secondary fund in 2019. And things went pretty great. But actually, I thought that the market was more ready for an investment bank specialized in secondary rather than platform. And so I called David and I say, hey, you already created your own investment bank. Can you do it again? Focus on secondaries. And that's how we managed to create NotSoLiquid.
That's great.
And you mentioned that in your recent article that we were acquired by Bryan Garnier. So it's a new chapter for us. And we're now part of a bigger institution called BG.
Yeah, thank you very much.
That's very cool. That's very cool. Yeah, so if I can, maybe just brag about your guys' business for a minute here. So, as you guys mentioned, you founded in 2021. You do secondary market liquidity solutions and also deal structuring. So maybe you can tell us a little bit more about the specific services. But I noted from your website, so you guys have 200 million euro of transaction volume across 16 deals and operate across 3 geographies. Very impressive, right? I think.
Yes.
I think we're maybe beyond that now.
Hey.
I believe it. I believe it, right?
Yeah, we are.
Websites always lag, right?
Let's brag more.
Yeah, very good, very good. So tell me a little bit more, just at a high level, about the services that you guys offer, and then perhaps Dave and Pierre, you guys just tell us about why Bryan Garnier for the partnership here.
Okay.
You want to start?
Yeah, I'm going to start, and you start for why Bryan Garnier.
Yeah.
Okay, so so the way we are doing so. I noticed that I think people that were listening to this podcast are pretty aware of how the secondary market is structured. So there is the private equity secondary market and the secondary for LP transaction that is really structured, especially for the buyout type of deals. And then there is the venture. And on the venture part, it was pretty much structured around broker in the US and platform, such as Forge, Manhattan Venture Partner, Hive, and this kind of thing. This worked really great in the US for different reasons: the typology of investors, the information you can have on the company, and also the familiarity with tech companies. In Europe, it's pretty much different because investor does not really like the brokerage type of deal, which means you can really not call an investor and say, hey, do you want to invest in SpaceX at that price? It will never happen. So we thought that, okay, so we have like 5 years. We are 5 years late behind the US regarding the venture capital industry. So in 5 years from now, we're gonna have to deal with secondaries, but we're gonna have to deal with it in an European way of doing it, which is structuring an investment bank, really transparent, of information, and also a lot of confidentiality. So
Okay.
we decided to create NotSoLiquid and to propose this service that is really tailor-made. We only deal with institutional investors on the buy side, and we don't do deal below 15 million. That's how we started, and we started on different companies like Ledger, Aircall, Algolia, and those companies are US based, but they used to be French based. And then it was really the perfect service at the perfect moment, and that's how we managed to do that much deal and in a little amount of time. And we are continue growing, and that's why we decided to join Bryan Garnier, because like the scale was pretty huge for the little team that we used to have.
Okay.
Yeah, sure. And actually, what we do is really a niche within the secondary market. So a niche within a niche, because we do mostly direct secondaries. So we help shareholders, early shareholders have liquidity and exit. And this is what struck the interest of Bryan Garnier, because they have a very large primary team on the private placement team. And also they have a large ECM team that do IPOs or post-market transactions. And we really bring this new bridge to their activity. So there's like synergies with fundraising, synergies with market transaction, public transactions. But we also, I think what they liked is this practice, and also the fact that we were dealing with venture-backed business. I mean, they're a tech investment bank. They do M&A since the 90s on tech companies, but it's not the same type of tech companies that we work on. They do companies that are very profitable, raise very little venture money, became profitable real quick, and they do LBOs after LBOs after LBOs. And it's the type of company we work on, because they have a way faster scale. They raise a lot more money, but they burn a lot longer. So they're very happy to get connected with this space, and this is what we bring to them as well on top of the secondary practice. So there's a new coverage in terms of deal, and a new practice in terms of activity.
This is really cool. So I love the dynamic, because naturally I'm here in New York, so I'm very familiar with the secondary market, for private company stock in the United States, but much less familiar in Europe. So you guys mentioned you do direct, mostly direct deals. So how do you source those deals? I mean, are you guys literally on the phone calling management or employees of the companies, or do you already have existing relationships, perhaps, from prior points in your career? Like, how do you go about, finding clients, I suppose, to represent on the market?
It's a pretty good question, actually. We don't do marketing at all. You have to know that the French market and the European market is really much smaller compared to the US. And we used to be in the VC ecosystem since 4 years, and we know like some of the top CEO of VC-backed French companies, and that's how we started to build our track records. And we just like took care of some position of some VCs in France, and then a VC calling another LP that call another VC, and we just started like this. And once you've done 6 or 7 transactions on the same market, you become kind of a reference, because it's a mouth to mouth business. I don't know if it's a
word of mouth
business, especially in France, and that's how we started. And we are the only one doing this in France, like in investment banking type. So as we have no competition and the name is pretty speaking for itself, that's how we managed to do what we do.
So tell me more about that. Are you guys providing services? I noted on your website, and then you also mentioned it here, that you're providing services to venture capital firms, right? So is most of that business coming from venture capital firm clients, or are they referring you to the founders of the companies that are then saying, "Hey, we'd like to do kind of a secondary sale"?
Yeah, interesting. Actually, it's kind of both, because we're a good friend with the early stage VC investors, and we know that in some situations they have like very good assets, but they're stuck with it on their portfolio, and sometimes the fund is getting old, a bit aged, I would say, and they really have to exit, and there's no IPO in view, and there's like zero for tech companies in Europe right now, or maybe one for Planet Square, but that's really an exception and not the rule. And the M&A exits are really not happening much. On comments for them, so they really come to us on purpose for themselves, but also they know, because they're usually still on board or still close to the board of those companies, that there's some liquidity plans for the companies. Sometimes for employees, they want like to do a block of liquidity for employees that are putting pressure on the founders, and they want it to be organized and not being unstructured and crazy. And they really indicate us situations where there could be a sponsored or a company-led secondary. And we have both situations. And actually, we have two types of sellers, because we're mostly sell-side oriented, institutional but early stage funds, and also companies / founders / employees. On the other hand, we do both situations.
So I got to say, the buzz that I generally hear from VCs is that they, selling in the secondary or before an IPO is kind of like frowned upon. I think that's changing though. What do you guys think? Is that the same? Do you feel like a sense from VCs and founders that it's okay if a VC fund has to sell in the secondary for all the reasons that DPI or whatever it is, right? I mean, what's your sense? Is it changing a little bit, or yeah?
Yeah, it's really depending on who you are. If you've been not stuck, but if you invested in a company 10 years ago, you know how IPO rolls, right? It's like we are going to do an IPO in 2024, and then in 2024, the market's not ready, let's go 2025.
Right.
And maybe 2026, and there is a lockup period that will be between 6 months and a year. And how the liquidity, when the company will go public, how the liquidity will be structured. Does the VC will be able to sell, I don't know, 50 or 100 million in a year, et cetera, et cetera. So if you want to secure your DPI, it's better to sell when the company is still private. The only problem, so it's a really good idea to do that pre-IPO, not for the VCs, but for the founder. They don't want the stock to drop when the lockup period will end. So give a bit of DPI to your early investors and employee, so you will be able to control the selling pressure when the company will go public. The only thing that is problematic is like most of the VCs, and we really love VCs, but that is something that is in the common knowledge, right? But most of the VCs overprice their position in the fund. And when they want to sell on the secondary market, they have to haircut the NAV. And so they have a choice between increasing the DPI and lowering the NAV. So year on year, the cash on cash multiple will be lower, but the DPI multiple will be higher. Or continue to stay on the same NAV paper priced businesses and portfolio and wait for an IPO. But at the end of the day, when you will have to sell, if you sell during an IPO or just before, you're going to have a discount. If you sell 100 million of a position during an IPO, you will do it on a dark pool because nobody will sell it on the public market directly. And in a dark pool, the discount are between 20 and 40%. So they have to be aware of that.
And also, the fact that you manage to go to perform an IPO doesn't mean that it's a success. It takes a bit of time. It takes like a year or two, and actually, if your share price mess up during this time, your listing can be done forever, and you can never recover. And a good example of that is some SPAC companies that use the SPAC or direct listing methodology to go public. 2 or 3 years ago, and a good example is GetAround. I mean, exactly 6 months and 1 day after the IPO, the share price dropped by 97%. Right. Not because the company is bad in itself. It's very decent compared to other listed company, and there's like they have good metrics, good usage growth. But actually, everybody needed to exit at the same time. And if they had done I don't know if it would have sufficed, but if they had done secondary rounds prior frequently and had like the corporate ventures exit, the early funds, the business angel, maybe it would have gone better. But now they're done. I mean, they should do a take private because it's I mean, and at what price? I think they can't raise debt anymore. They can't get financing anymore. It's fucked up. And I mean, that's an extreme example, but even for way better and way more qualitative company, it can be disastrous.
Yep. Yeah, I mean that's.
Yeah,
I mean, listen, the secondary. I'm a big. Listen, I'm a big believer of the secondary market, right? And I think there's a lot of value to be added for both companies and venture capital funds for participating there. But I'm curious, like you guys, the price is what I'm noticing too, right? Especially as I talk to VCs myself. That Pierre, to your point, they price their holdings, I think, higher than traditionally where the secondary market has it. How do you guys go about doing that? Are you looking at kind of where trades are going off in the secondary, or do you just kind of go back to like traditional investment banking and you break out the spreadsheet and start doing, cash flow analysis? Like, how do you go about kind of looking at valuing the companies when you're bringing something to market?
So we believe in two things. We believe in the public market, and we believe in the waterfall and the shareholder agreement. So whatever happens in the last round in terms of valuation, we never talk about it because 2021 was not the real world. It was a world where the money was free. So basically, it's not the real world.
Right.
So the thing we do is like we are taking the public comps. We are comparing the company to his public comparable in terms of revenue growth, gross margin, tech, the typology of asset they have. Like we come from the large cap investment banking. So we are just doing simple valuation. We are trying obviously to maximize the valuation because we are always in sell side. So our clients are the sellers.
Mm-hmm. Right.
And then we are seeing what kind of shares are we selling? What are the stack of pref? What was negotiated during the last round? And sometimes we're saying, okay, the common shares are worthless. And it's happened like 1 out of 3 deals, we can't sell the common shares. But that's the game, right? Like we were not the one negotiating really bad preferences in 2021. So basically that's how we evaluate companies. And we don't care about the NAV of the VCs. We don't believe in that either. I mean, it's just a number in an Excel sheet. And so we prefer to do our own valuation.
Yeah, sure. And also, I mean, the methodology that we use are the same that investor did actually. Most of our models that, I mean, combine, they're like things that we gather from investors that really detailed and explain how they would value and say, oh, actually, we should take that and embrace it and use it because that's how the market is going to talk. And usually we're kind of right. I mean, eventually it's the direction is usually very precise eventually.
Oh, I'm sure you guys are very right. I mean, what the thing is, human beings, I think, lock themselves in a number. And I think, Pierre, what you said about 2021 is like rock solid. Like, they just can't forget that valuation that happened in 2021, right? So it's like their benchmark now. But David, you mentioned something earlier.
People in the public market and ask them, do you still believe in the 2021 valuation? And a guy that is a trader on the public market will say, yeah, I would have to sell in 2021, but I didn't. And now I lose 50% of my money. But a guy on the private market is like, yeah, it's still worth 2021 valuation, which doesn't make any sense, especially when you say, don't worry, the company will IPO. But dude, you price it at 20 times the annual recurring revenue. And I have 20 comps that is trading at 7. How do you justify the fact that the company will trade at 20 times?
That's right.
But and they can't. So we have to be super careful regarding valuation because we don't want to lose our investors.
Right.
Yeah, sure.
That's true. It's true.
But also we don't want to be disappointing and create fake expectation on sellers and pretend that we can do and achieve a value that is not achievable. I mean, we're not selling discounted company per se, but we want to be realistic and have a setup that works, and we really push sellers, shareholders to be realistic and so that liquidity is possible, but actually you have to be realistic and embrace the fair pricing of the market. You can still wait a bit, but it's going to be still priced the same. I mean, we don't believe that there's going to be a crazy inflation like it happened in the past 4 years, and we're back to the normal, I guess. And no, it's more fair.
Yes. So I tell you what. So David, you had mentioned something earlier, which I'm starting to see a major trend of with a lot of kind of what I call like pre-IPO stock companies. Is this more of like a structured tender process, right?
Yeah,
where
exactly.
there's a tender every 6 months or every year, and there's a lot of companies doing this now, right? I mean,
Sure.
are you guys seeing that as well, or do you kind of agree with that trend? Do you think it's going to continue? And then also, it sounds like maybe you guys are in position, you're like in a prime position to be able to help companies navigate that or start one if they want to. So talk to me about that. What are you seeing?
I mean, that's completely true. I mean, there was some very successful tender offers or company-led secondaries recently. I mean, what happened on Canva was like a great example, or more recently, Stripe in the US, they organized that for the early employees and business angels, and it was quite successful. I mean, they embraced that the valuation could not be less from valuation, but also they were a bit ambitious on the price. So they found a good balance that managed to seduce the market, and we think it's great. There are like use cases that we take a lot now to be ambassador for this and to promote this to French or European tech companies, and also in the UK. I think we think they should do that more and more, and also, I mean, for several reasons. First, bringing liquidity is healthy. If you prepare for IPO, as I mentioned earlier, it's very healthy that the people that want to exist are replaced by later stage investors that want to stay and they have a long-term perspective and more value to bring. But also, I mean, from a company, an employer perspective, you show that that you have a real market valuation, and that stock options are not only paper, but they are converted into a real asset that has a real value, and it's a recurring thing. It's not an exception or a chance. And what we see is that a lot of early employees, C-levels that are in the operation or not anymore, business angels, they come to us, but without synchronicity, they have their own thing, they have a price in mind, and it's really heterogeneous. And we think that the company that really wants to take the lead on that, it takes time for the legal team, it takes time for the finance team. It could be, it's a bit risky, but it's worth it. I think it's an investment that is worth being made for the equity story of the company, for the whole value creation for employees and for early investors, and
also giving back. Like we really want to build an healthy ecosystem, and if you don't give back the money to seed funds and business angel, how are they going to reinvest into the new companies, etc., etc. So for companies, it's we often heard CEOs after an exit saying, "I created my own seed fund to give back to the ecosystem," but we never heard the company saying, "We'll do secondary to give back to the ecosystem as well." But you should do it because you have employees, you pay them with paper, you manage to raise funds, like sure 6-7 years ago, but you have to give back the money, right?
Yeah.
And that's the rule.
Yes.
You know?
Well, I would argue, and tell me if you guys agree with this, that if you offer these structured tenders, you have more control as a CEO and CFO of a company, right? So to your point, you can kind of control. I think you have more control about volumes, even sell side, downside pressure when you go public, like you mentioned, David. But then also too, I think, I mean, if you look at the companies that are doing these structured tenders, like every 6 months or every year, the secondary market just snaps to that number wherever they price it at, right? And also, I think it attracts some more institutional investors. So the price where the stock is trading at, I think, is a more thoughtful, price point too. Do you guys agree with that? Like, what are your thoughts about that?
We agree 100% on that, and we wish that all of our clients will be structured like this. And we want to bring the auction system to France and to Europe, and to every company that worth more than $500 million or even 200 million should do it, because it's a great way to evaluate your different stock, great way to reprice every year because you guys have the 409A in the US. We have nothing in Europe. You can do whatever the fuck you want with the pricing. So it's a great way to price the stock option. It's a great way to give liquidity. It's a great way to justify your value. It's a great way to do external growth. If you want to buy out a company and you just did a secondary round, you can buy the company with shares. You can do a share deal because you have a real value on it, and you can give shares to the founders and shareholder of the company you just bought without raising debt or more cash. So it's a great way to prove that your company worth that number. And this is priceless. Without any joke.
So yeah, no, listen, I think it's I think it's fascinating. I mean, this market, just give me a sense of the market in Europe, like in the secondary space. Yeah. It sounds like it's growing, right? I noticed in your press release that you had about your transaction recently that you had some statistics in there, but is the European kind of secondary market, like kind of pre-IPO market, is that growing in transaction volume or number of companies participating or whatever metric that you think is interesting to talk about?
Yeah, I mean, it's interesting. I mean, we did a market sizing of our niche, which is the direct secondaries market. We estimate that in the US, it's probably a bit less than $100 billion in size. I mean, it's way more advanced, more structured. There are like market players that do it very well and facilitates that, and transactions happen organically also way easily. In Europe, it's a lot smaller. I think it's 10 times smaller. We estimate that it's probably $11 billion or less, and probably it's going to take 10 years to reach the current level of the US. Pierre says 5 years because he's very ambitious, but I think it's going to take a bit more time. And we see really few players wanting to be facilitators, intermediaries on that. Pierre said that we're the only one in France, but I think we're the only one in Europe. We know that some large investment banks, they want to recruit secondary teams, but we don't think that they want them to do what we do, but more probably LP transactions or some JP-led, but more traditional form of JP-led secondary, such as continuation fund, a structured solution, which we can do as well. But we think funds can do that themselves. The facilitation is less interesting, we think, there. And we don't think that they're going to do much in the venture space. I mean, the market is small, but it's growing, and there's like a lot of catch up to do with the US. So good opportunity.
So, good opportunity for NotSoLiquid, maybe like 50% plus market share, right? Over the next 5 to 10 years. That's the plan. I like that. I like that a lot. So maybe I could
take it all. If nobody wants
switch gears a little bit. Let's just talk about. That's right. That's right. So guys, I'm sure that you're talking with your buyers as well, right? I mean, we've talked a lot about your relationship with your sellers and their motivation for why the sellers would want to bring shares to the market. But in your conversation with your buyers, are there any trends that you're noticing right now? Like, are there like AI? Like, is everybody interested in getting AI exposure? Is fintech still kind of a hot dot? Like, what sectors are kind of in, asset classes, if you will, within this space that buyers seem to have the most interested in there in Europe?
So obviously there is AI, and there is like two big hubs of AI in the world. There is the US and there is France.
Yeah.
We have Mistral and Poolside, which are the two biggest AI company in France, and you have the OpenAI thing. It's pretty huge.
Yeah.
But we use Mistral in France because we're French, right?
Sure.
Anyway, so of course AI is doing a lot of noise, and investors. So DLP is opening the newspaper. He's seeing AI companies, so he wants his portfolio manager to have AI companies. It's been like this since the beginning of finance. So there is a lot of people that wish to invest in AI. But it's really hard to have fair valuation in AI. It's really hard to have any kind of information on AI companies. Like if you want to
Mhm.
sell some OpenAI stock, you will have nearly zero information on the company.
Right.
So the trend right now is there is several family offices and big private bank that wish to invest in AI for their clients. And the vast majority of our investors, they wish to invest in companies that are nearly rule of 40, which is like, for example, 25% growth, 50% EBITDA, with recurring revenue, more than 100 million revenue, proven tech. And this is what people search right now, is like they want to reduce their risk but still invest in tech.
Sure.
And of course, there is
It's a
the
paradox,
shiny thing that everyone wants to invest in OpenAI, a 100 billion valuation. That the thing we say to a client that want to invest in OpenAI is just buy Microsoft stock. It's
Yeah.
gonna be fine.
There's some truth to that. There's some truth to that. Yeah. I mean, AI seems like the only thing that people are talking about in the United States. You know that,
Yeah,
and
sure.
at least in the U.S., it's that. It's space economy stocks and Anduril, which I would say defense tech, but it's really just the one company right now. At least is Anduril in the late stage space. But
Yeah, GovTech, SpaceTech, which are actually two companies each.
yeah,
But
right. So
people should be careful with AI and space tech. I mean, it's we already experienced that in 2021. We hope people will not do the same mistake. I mean, remember Web3? Remember NFTs? Remember the beginning of blockchain, where everyone wanted to invest in blockchain, and how many companies are still alive now? And it will be the same with AI, guys. And so that's why we try to not push our investor to invest in that.
Yeah, and especially generative AI. I mean, there's some great businesses, but I think it's hard to discriminate, and a lot of them are actually very gimmicky when you look into it. Say, oh, actually, it's very basic. It's very low tech. When you look it up, and the current traction is probably not sustainable.
It's just a plug on OpenAI. That's it.
Yeah, it has like negative margins. It can't work.
Yes, I mean we have a lot of CIOs I talk to are kind of leaning more towards, like, they call it the picks and shovels play for AI, right? Which is like a Hugging Face or a Databricks or a CoreWeave or a Grok, right? So the chips, the cloud providers, other types of solutions, data labeling, right? Scale AI, where that seems to be perhaps a more thoughtful place to play in, right? As opposed into the kind of like more consumer facing front end or enterprise facing front end large language model space.
But
right?
actually, Hugging Face is one of the best company I ever seen in my life.
And they're French.
They are French, but it's not the reason why. But it's really one of the best company ever made.
That's great. That's great. So fellas, how does it work? How does it work with your clients? So your buyers come to you. Do your buyers ever come to you? Like we just talked about, kind of things that they're interested in, and you're like, okay, look, we don't have any companies that we're representing right now in that space, but you know what? Because of it's, Mr. Smith and Mr. Jones at XYZ bank or, firm or family office, like we're going to go and try and see if we can source some opportunities for them. So is that how you kind of stitch deals together? Or do you get demand from kind of the buy side and then you go and find it on the sell side to fill it?
Yeah, that's true. Actually, we really try to have like a very qualified coverage. So we really talk to investor, potential buyers all the time to scope and be more precise into what they want. Sometimes we try to identify specific names, verticals, size. I mean, we think we're getting more and more precise. And now at Bryan Garnier, we have like a lot more coverage. I mean, there's even a sales team that do that all day for us and put that data into our CRM, and we get better and better. I think we have 4 types of buyers. I mean, the first category is like traditional secondary funds that already did that for the past 10 years, but they're more used to do a diversified portfolio. And when they do direct, they want really discounted situations, and we don't have that. I mean, we don't do bottom fishing. So we really work more with the other categories, which are the growth/private equity fund. Actually, they also do primaries, but since they really like deal flows these days, because there's after Series B, there's really a shortage of good transaction, and it's hard to remain competitive. And secondary market is really a possibility to enter in great assets with less competition, sometimes a bit less information, but sufficiently to put a price, sometimes a bit lower, but not always. The other family, the third one, is also great. It's the crossover funds, the hedge fund, the pension fund, the sovereign funds that usually invest in the public market, but they are trying to capture value of companies several years before they do their IPO, and they think the entry point is right now. And the secondary market is perfect for them because usually they can't be competitive in the primary rounds. They can't lead. It's hard for them to manage that. They can be followers, but if they're invited, and since they're not LPs or have relationship with other ventures, it's hard for them to enter. And secondary is a good way to have those assets. And the last category is more alternative. It's family offices, people that are usually LPs or indirect investors, and they want to do direct as well for several reasons, because the family is related to the vertical of the business, or because they have curiosity, or they want diversification. That's the main reason. And sometimes, in the same category, we have like corporate. We don't do that much. Sometimes insurance company, but it's really opportunistic. We don't target them specifically. It just happens organically that they want to look at something, and we have it at the same time.
Well, so gentlemen, I think you guys have an incredible business. I want to end it here for us. But I think you have an incredible business, and I am definitely rooting for you. The service that you're providing in the marketplace.
You can't invest. We already sold the company, Aaron.
You never know, man. Maybe one day in the future, you guys carve out a little piece for me. But I think it's an incredible business. You have an incredible business, and it's going to grow. This to me seems so obvious that this private secondary market is going to only get bigger, right? So, and I'm sure it's going to happen there in Europe, and you're in the prime position to capture that. So I hope you're 10 times more successful than your wildest imaginations, gentlemen. And it sounds like you're already that way. So I hope it continues. But if anybody wants to get in touch with you guys, right? What's the best way, if they're founders or buyers, right, in Europe there, like what's the best way to get in touch with you? Go ahead.
We really like LinkedIn. I think LinkedIn, we really have a lot of people connecting with us there. I think 2/3 of our deal flow right now is either through friends and relationship, or people contacted us proactively on LinkedIn and say, "Oh, I'm an investor in this scale up. I would like to see what you can do for me. Let's talk." And that's a great channel to contact us.
Yeah.
That's awesome. That's great. Well, I would recommend any founder.
We can put our work email as well, but actually LinkedIn is the best way to get in touch.
Yeah.
Okay, done. Perfect. So I would recommend any tech founder in Europe to call you guys and start a relationship at least, right? Just start a conversation. That would be very smart, I think, in my opinion. So gentlemen, thank you for your time. It was very nice of you guys to do this. I appreciate it.
Aaron. And if you come to Paris, just ping us, and we will be happy to have a drink.
Let's do that.
Thanks,
Aaron.
I will take you up on. Thank you, gentlemen. Appreciate it.
Goodbye.
All right. Cheers.